Welcome to The Explainer. Today we're dissecting a highly specific strategic maneuver in the pharma sector, Lupin's recent move with Kaveri Therapeutics. Look, when a heavyweight like Lupin reorganizes its oncology assets, it sends a massive signal about where they see the future of drug development and risk management. We're going to deconstruct the exact anatomy of this transaction, breaking down how scientific assets are essentially being traded for structural equity and what this all means for their clinical pipeline moving forward. Okay, let's dive into this. How does a pharma giant restructure its oncology pipeline? The high-stakes reality we're dealing with here is figuring out how a major player revamps a heavy pipeline without losing that potential blockbuster upside. I mean, we all know that bringing an oncology drug through phase 1 and 2 trials carries a completely massive burn rate. Sometimes a really promising candidate just gets bottlenecked inside a giant corporate R&D machine, something because it's competing for internal funding against a dozen other top priorities. So the dilemma Lupin faced was how to keep these specific assets moving forward without severely bloating their own R&D expenditure. They absolutely had to find a creative structural solution to give these therapies the dedicated runway they need.
And that brings us to the deal unpacked, a major strategic shift involving oncology assets. Lupin didn't just sideline these programs. They engineered a really calculated spin-out maneuver. By evaluating their portfolio, they realized that these particular targeted therapies required a much more agile, focused environment to actually thrive. You know, the kind of environment that a smaller, dedicated biotech could provide. This isn't an abandonment of the science at all. It's a fundamental reorganization of the funding model and management structure. It's designed to accelerate clinical milestones while keeping the assets perfectly aligned with Lupin's long-term oncology ambitions.
And this brilliantly illustrates the core mechanics of the trade. On one side, Lupin transfers 2 cancer candidates from their direct pipeline, but on the other side, in return, they receive an 82% equity stake in Kaveri Therapeutics. It is a literal, direct exchange of intellectual property and early-stage scientific data for massive corporate ownership. They are essentially capitalizing Kaveri using the drug candidates themselves as the currency rather than just injecting raw cash. It's a really fascinating play. Let's look closer at the assets. Transferring 2 critical cancer candidates out of the primary pipeline represents a huge shift in day-to-day scientific strategy. These therapies involve highly complex biological pathways that require intense, dedicated focus to navigate the regulatory hurdles of clinical trials. By transferring them, Lupin is essentially acknowledging that a specialized biotech environment might actually be the optimal incubator. Well, actually, it's more than that. It allows the research to proceed with the true agility of a startup, totally free from the bureaucratic drag that can sometimes really slow down agile development inside a massive global pharmaceutical company. So tracing this origin to destination supply chain from Lupin to Kaveri Therapeutics with 2 core oncology drug candidates reveals the operational reality of the deal. Handing over the keys to Kaveri means Lupin is fundamentally shifting the logistical burden. Kaveri takes on the day-to-day burn rate. They manage the trial designs, the patient recruitment, and the immediate scientific pivots. Lupin completely clears the immediate overhead and operational risk off their own desks, while Kaveri instantly gains a robust, ready-to-develop oncology pipeline that entirely validates their existence as a biotech entity.
But let's be clear, Lupin isn't just acting as a generous benefactor here. The return, securing majority corporate control, is all about financial engineering and risk mitigation. They are spinning these assets out specifically to keep those heavy R&D costs off their primary balance sheet, which, of course, keeps their core margins looking incredibly healthy to investors. Yet, by trading direct asset ownership for powerful corporate leverage, they retain virtually all of the commercial upside. Think about it. If these drugs hit their endpoints and achieve FDA approval, Lupin is positioned perfectly to reap the rewards, all without having carried the day-to-day risk on their own books.
So the crucial point is 82%. Understanding what an 82% stake legally and practically means for the future is key. With a slice of the pie this large, Lupin maintains overwhelming board dominance and ultimate voting power. They have the sheer ability to consolidate Kaveri's financials right into their own if needed, or entirely dictate major strategic pivots. But more importantly, if these 2 drug candidates suddenly show incredible phase 2 data and their valuation skyrockets, Lupin has an incredibly easy, pre-paved path to simply buy out the remaining minority stake and pull those fully de-risked assets right back in-house. Now, what's really interesting about this slide is that remaining 18% equity. While Lupin holds the lion's share at 82%, that minority slice is vital. It's typically held by the original founders, the incoming executive team, or the key scientists over at Kaveri. And this structure, it's a massive incentive mechanism. It ensures that the dedicated team actually running the day-to-day trials has serious skin in the game.
I mean, they aren't just employees of Lupin anymore, they are equity holders in Kaveri. Their personal financial success is tied directly to successfully pushing these two cancer candidates through the clinic, which perfectly aligns their drive with Lupin's ultimate goals.
Which leaves us with a much bigger strategic question to ponder. With an 82% stake secured, will these two cancer candidates find faster success under Kaveri Therapeutics? More importantly, is Lupin's structural gamble here going to become the new blueprint for Big Pharma? It's a brilliant way to offload risky R&D and incentivize a startup team while essentially keeping the IP in the family. Whether this is the future of oncology drug development or just a really clever accounting maneuver, well, that's going to depend entirely on the upcoming clinical data. But it's a deal structure we'll be watching very, very closely. Thanks for tuning into this explainer, and we will see you on the next one.